Topic examines the policy measures required to achieve sustainable economic growth while maintaining low and stable inflation. The topic explains that long-term macro-financial stability depends on the effective coordination of monetary, fiscal, prudential, and structural policies. Policymakers face the challenge of supporting economic activity without creating excessive inflationary pressures or financial imbalances. Stable inflation encourages investment, preserves purchasing power, and strengthens confidence in financial systems, while sustainable growth improves employment, productivity, and living standards. The topic emphasizes that macroeconomic stability is not achieved through a single policy tool, but instead requires a balanced and coordinated framework capable of adapting to changing economic conditions and structural challenges. A major focus of the topic is monetary policy and the role central banks play in controlling inflation and supporting economic stability. Central banks influence economic activity primarily through interest rate adjustments, liquidity management, and communication strategies. During periods of excessive inflation, tighter monetary policy and higher interest rates help reduce aggregate demand and stabilize prices. Conversely, during economic slowdowns, accommodative policies can support borrowing, investment, and consumption. The topic highlights that credible and independent central banks are essential for anchoring inflation expectations and maintaining market confidence. However, monetary policy alone may not be sufficient to address structural weaknesses, supply shocks, or long-term productivity challenges affecting economic performance. The topic also emphasizes the importance of fiscal policy in promoting sustainable economic growth. Governments influence economic conditions through taxation, public spending, infrastructure investment, and social programs. Productive fiscal policies can improve long-term growth by supporting education, technology, transportation systems, and labor market development. However, excessive government borrowing and persistent fiscal deficits may increase inflationary pressures, crowd out private investment, and weaken confidence in public finances. The topic suggests that prudent fiscal discipline is essential for maintaining macroeconomic stability, particularly during periods of rising public debt or elevated interest rates. Effective coordination between fiscal authorities and central banks therefore plays a critical role in preserving economic resilience and financial stability. Another important theme in the topic involves prudential and structural reforms designed to strengthen the financial system and improve long-term economic productivity. Prudential policies focus on maintaining banking sector resilience through capital requirements, liquidity standards, stress testing, and risk management oversight. Strong financial institutions improve the ability of economies to withstand shocks and support sustainable credit growth. Structural reforms address deeper economic inefficiencies by improving labor market flexibility, encouraging innovation, enhancing competition, and increasing productivity growth. The topic emphasizes that economies with stronger institutions, flexible markets, and efficient regulatory systems are generally better positioned to maintain low inflation and stable long-term growth under changing global economic conditions. The topic concludes by emphasizing that achieving low inflation and sustainable growth requires policymakers to balance short-term stabilization objectives with long-term structural priorities. Economic shocks such as supply disruptions, geopolitical tensions, financial crises, or rapid monetary tightening can create difficult trade-offs between inflation control and growth support. Policymakers must therefore maintain credible institutions, flexible policy frameworks, and strong coordination across monetary, fiscal, and prudential authorities. Effective communication and forward-looking risk management are also essential for preserving market confidence and anchoring expectations. Ultimately, the topic highlights that sustainable macro-financial stability depends on disciplined policy implementation, institutional credibility, and the ability to adapt proactively to evolving economic and financial risks within an increasingly interconnected global economy.